Hi, my name is Brett from SteadyOptionIncome.com, and today I want to talk about how can you hold a position over earnings. Earnings are definitely a risk because you don't know which way they're going to go. So if earnings are bad, then the stock could drop below your strike. Now, as an option put writer, this is something you don't really want to have happen. So we're going to see how can you hold that position across earnings and still come out pretty good shape. So we're going to look at a stock called SRPT. I see a lot of people writing this right now. This is kind of getting into the middle of August, and people are writing the September contracts. The August contracts are starting to decay fairly rapidly at this point, but there's good premiums on this. However, it is risky. But we're going to use it as an example. Now, it's risky because it's a therapeutics company. This kind of falls in line with biotechnology and pharmaceuticals, which are also very risky. They're very risky because normally they don't do well with earnings. So right off the bat, maybe you may not even want to get involved with these things in earnings when the earnings come out because they're just not going to do good. They don't really turn profits. The other thing is that their trials, their approvals by the FDA, other different government entities may disapprove whatever they're trying to push through. Clinical results can come back bad. And normally when that happens, these types of companies, therapeutics, pharmaceuticals, biotechnology, will get their stock price will get cut in half. So for this example, I'm kind of doing it realistic. What I normally do is just get a strike that's roughly half under whatever the current stock price is. So here, let's say the stock price closed at last close at 25.26. So what I'd be looking for is an 8 strike, which looks really good because on the chart there's support down to like $10, and the low this thing ever hit was 8. But I feel pretty comfortable being well under half of the current stock price. So this is a September monthly. The strike is 8. That's what the setup is here. Now, let's talk about, say, 6 contracts. You got $1 premium off of those. Maybe you bought them in probably mid-July to get this $1 premium. Although right now I think it's going for like 92 cents. So premiums are still fairly high. And that results in $600 worth of premium on 6 contracts at $1. Now, roughly, the put option margin would be $5,500. Remember, we're writing puts here, so we're selling to open puts. And these are not cash secured, so there's no stock involved. These are just straight out puts. So roughly, we have $5,500 of option margin. If these were put to us, then we would have 6 contracts times $25. This would be $15,000. Roughly, it's going to be about half of it. Kind of depends on your broker and if the margin has even increased on this. Now, it's very possible if this stock drops to $10 or $12 because something bad happened, some disallowed drug or some bad result with clinical trials, are just not the results anyone was looking for across a number of different things, and that comes out in the press, the margins can increase. So the margins can increase if you're still in the option position or if it's been assigned at some point and you're in the stock position. Margins can increase on either one if the stock happens to drop fairly quick. But so $15,000, and with most brokers, it's 50% on a stock. So it'd be like $7,500 that your margin requirement would be if it gets assigned. So how do you mitigate this if, let's say, today is 8/14 and earnings are coming up the end of the month? So there's a little bit of time for you to prepare and move things around and kind of get in front of this in a prepared way. Because if you wait until you get really close to this earnings date, you're going to be in a position that you're going to kind of be forced to do something rather than now where you have the luxury of still being in control. Because as we move up to the earnings date, things are going to start happening with the stock. There's going to be anticipation. People may start selling out of it in anticipation of earnings, or people may be anticipating something really good. They'll start buying a lot of shares, which is good for you, but you just don't know which way it's going to go. So that's why I'm saying it's best not to be involved with earnings if this is considered a big position for you. So if you normally trade 2 or 3 contracts and now you're holding 6, well, that's obviously a very big position. My guess is it has a fairly significant impact on your portfolio. So this could be a pretty good percentage of your portfolio, which is kind of a bad thing to begin with anyway, because you don't want to have too much concentration in one area. So let's say that this is not a huge part of your portfolio, but it's above average for you. So again, if you're doing 2 or 3 contracts at a time, we're above average. And what we want to do is mitigate going into this earnings. So let's say the goal here was to capture this premium, but now earnings is creeping up and the premiums have not fallen as quick as you would like them to, or rather the price of the option is not falling as quick as you would like it to, so you're not capturing as much premium. Now, that being the case, and even if you were capturing a lot of premium, you may just want to sell out and close this position ahead of earnings, given the kind of stock we're dealing with. Again, going back to therapeutics, biotechnology, and pharmaceuticals. So to stay in this position, to capture some of this premium and take a chance with these earnings while greatly mitigating your risk, the thing to do here would be to sell out some contracts. So here we're going to sell 4 contracts. We're going to capture a good bit of premium, and probably at this point the contracts are going to be or the option prices are going to be a lot lower. So you're going to capture a nice amount of premium, but you're still in this position. And what that's done is brought your margin down. So let's look at the impact. Before, we were requiring $5,500 of option margin. Now we're down to, let's say, roughly $1,500. If it's assigned to us and the stock drops to $10, we've gone from an initial margin of $15,000 to $2,000, which means 50% as a stock is going to be only $1,000 margin. So now we're in really good shape. If this gets assigned, so we have the 8 contract, and if this goes to $10 and keeps going down, goes down to $8.50, $8, $7.50, $7, maybe $6.50, very possible. It's a very realistic scenario. So at $6.50, we're $1.50 away from our strike. We get assigned, and our margin requirement may go up some. So we're only holding, again, $1,000 of margin on the stock because it got assigned to us. There's only 200 shares. We do capture our premium, whatever it is. It's going to, we'll probably capture the full amount because of the stock price being below our strike. So we actually come out in a pretty good situation. Now, with the stock plummeting so much, close to 75%, there's a good chance it's going to bounce, and because it's only $1.50 away from our strike, we can go ahead and just sit there and wait a little bit because we're not holding a lot of margin. This is not a lot taking up from other opportunities. So the opportunity cost is really low here with only $1,000 margin. And if the margin increases because this has become such a risky stock, and it probably will, let's say $1,500 or $2,000 now is what the margin has increased to, we're still sitting in a good position because, again, it's not a lot of margin. It's only 200 shares of the stock, and we're not that far from getting out of it. We have captured our premium, so we would have to calculate if we want to go ahead and just throw this thing off and close the position out, net of the option premium and the loss on the stock, do we come out ahead? Do we come out break even? So this is a very personal decision. Just like all of trading is, there's not, really a good answer to give someone on that situation. It's really just up to you. It's very, very personal which way you'd want to go. But if you feel like, okay, this thing has dropped a lot, it's starting to rise, let's say it's been 3 or 4 days, you can see it starting to tick back up. People are starting to come in. They think this is an opportunity. The drop is way out of whack. Then you may just hold. Now, I know some people would want to write a covered call on this at, maybe the strike you got in, $8. If you want to hold it, yes, do that. If you want to hold on to this for a while, then you can do something like that. I don't really care to hold pharmaceuticals, therapeutics, or biotechnology just because of all the risk involved. I mean, not only can they fail or get disapproved on something, fail a clinical trial, get disapproved on a drug, a number of other things can go on. They can go bankrupt. This is just a very risky space. And I chose this stock really just to elaborate on those points. So I would not want to hold it. I would not want to write covered calls on it, because now to capture the covered call premium, I would have to probably write it in October, not September, October. That's, again, a personal decision. You may have more information on the stock. You may follow it a lot closer, and you think there's good things coming down the road. And maybe the company's even battling with what the FDA said or what happened with the clinical trials. Maybe there was an error during the clinical trials that was simple enough to capture, and they're going to run the trial again. So it just depends. Just depends on where you are with this, how it affects your entire portfolio, and your comfort level with holding it. In summary, this is a way to mitigate your risk going into earnings. Just decrease on contracts if you are above, what you're usually trading at. Now, if you're at a level that you're usually trading at, so if we went in initially with 2 contracts and we normally trade 2 or 3, there's nothing really to do there. You're at a comfort level. It's not a high impact on your portfolio, and you may just want to hold across earnings and see what happens, because whatever does happen, it's not going to be a great impact on the portfolio, and the risk is worth the reward. So that's kind of what it comes down to. So again, my name is Brett from Steady Option Income. And if you would like to learn more about Steady Option Income, just head over to the website at steadyoptionincome.com, and you can sign up right here. This is to learn more about how writing put options work, how to earn income from those. That's a free newsletter. Now, if you're already an option put writer, you can go to the subscription side. There's 2 different subscriptions here. They're basically the same thing, but you get a discount on one versus the other for signing up for a bit longer. But this is a daily newsletter, comes out every day the market is open. There's a list of options that you can write premiums on. They're quality stocks. The underlyings are quality because they've been vetted quite thoroughly. Not only is it a list of options, but there's macro and market commentary to build out a bigger picture of what's going on with the economy. So that's the macro side. And then what exactly is happening in the stock market itself. So that is the market side of the commentary. And there's pretty thorough bit of commentary that comes out each day. So it's going to help you form a whole picture and figure out, how you might want to position your portfolio overall. Do you want to slant more to cash given what might be coming, or do you want to get fully invested? Creating a great round picture. And this is the only newsletter that is dedicated to put option writers. So again, if you're spending so much time or just a lot of time trying to find premiums, then you can sign up, start using the newsletter, and decrease all that time you're spending on premiums and focus in other areas rather than having to chase premiums. So again, my name is Brett from Steady Option Income. Thank you for watching.